G'day everyone, welcome back to the show. Vincent Turner, your host. We're going to be talking actually about something today on the show we haven't talked about before, which is commercial lending in all its forms. And so it's going to be a lot to cover. But for anyone who's a business owner, maybe thinking of starting a business or has been in this for 10 or 20 years and, I don't know, feeling trapped or feeling like maybe you haven't got the right financing partner on your side, this is the episode for you. So firstly, welcome Nick Sharma to the show.
Hello.
It's good to have you here. Nick is our foremost expert on all things commercial. So I've thrown him into it already.
Yeah.
So Nick, look, before we dive into all the topics today, why don't you tell us just a little bit about you and your background, like how you came to be working on all this, and then we're going to dive into everything we're going to talk about today.
Sure, right. My name is Nick Sharma. I started my banking career in commercial banking about a decade ago, and that was back in New Zealand. Moved to Australia, worked for a couple of majors for a couple of years, and then I moved to the State Treasury of Victoria.
Okay.
Where I sort of consulted or provided consulting to the government departments about debt structuring,
Right.
interest rate risk, and all that sort of stuff. So now, as being a broker with just want to pass on that information that I've learned from the institutional government level and pass it on to my clients who are property developers, home owners, business owners, and see how they can value or have the same value proposition as an institutional client.
Right. Interesting.
So, yeah.
And look, I want to firstly just dive into some part of this because a lot of the path you often see as a commercial broker has come out of a bank. And so you have done that in part, but you've also come out of kind of institutional government. Like, what's the connection here? What's the connection between government institutional funding and, the price you might pay for a business loan?
No, absolutely. I think it's all tied up because of the interest rate at which the government borrows money by issuing debt or issuing bonds, that trickles down through the economy to the interest rate that banks charge or you end up paying as a homeowner.
Right.
So it's all interconnected. It's all part of the bigger inflation, bigger macroeconomics picture.
Yeah.
Where's the inflation rate? What's the OCR going to do?
Yeah. What's the OCR?
So that's the official cash rate.
Okay, right. Okay. That's our first 3-letter acronym for the day. Awesome. There'll be more, I'm sure.
There will be plenty, yes. So, today I wanted to have this podcast, so just to cut out all the jargon, the bank topics, and just turn it into simple, meaningful way for the listeners. And they're able to interpret what the bond yields are, what's OCR, how should I structure my debt, where am I going wrong? And there's a lot of insolvency in the market right now because of the high interest rate in the business space.
Sure.
So we're going to touch on that a little bit as well. And couple of topics we're going to cover.
Yeah, it's wonderful. And look, I think we're going to come back to this in more detail, but I kind of want to start here because I think it'll help us with kind of the arc of today. Like, just give me a sense of the kind of the major financial products that exist and the problems they typically solve for a business owner. We don't have to go into detail, but just start us there because then we can dive into the detail from there.
Great question. So, look, depending on what sort of a business owner you are, first of all, I would want to touch on businesses have different stage or where they are.
Right.
So, for example, if you've got inception of an idea which you want to turn into a business down the line, you're probably talking about angel investors, venture capitalists, and those sort of firms to raise money for your business, right? Mm-hmm. It's not in motion at the moment. Right. That could be a lot of pharmaceutical companies. There could be other ideas that are like Uber or platforms that are sort of in inception stage.
Right.
A lot of businesses that we deal with in Australia, they're past that stage. They're already operational and functional.
Got it.
Right. So, but in the beginning stage, or when sort of, for example, a business owner who wants to open a cafe, so he's pretty new.
Yeah.
Right. The debt becomes riskier from the bank's perspective because A, he's not experienced. B, it's a high attrition industry. Yep. A lot of people end up opening cafes, but they shut down in 6 to 9 months. And the banks know this from experience. So you might think your cafe is going to do excellent. It's going to be a great market player, but the banks know from statistics or data, well, 90% of them will shut down in a year's time.
Right.
So they deem you riskier. So you got to back that loan up by an asset.
Sure.
Could be like if you're buying a franchise, home, or other assets. If you want to do fit outs, you want to buy a coffee machine, that all costs money, and the banks do love to see some security there. Right. If you're in the rate of risk because the risk is higher, the rate of interest is going to be higher for you.
Sure.
On the so that's business type A.
Yeah.
Business type B is you've been in operation for about a year, 2 years. You're doing your business. You're profitable.
Okay.
And you want to grow. You want to buy another coffee machine or buy another franchise or open another cafe in a different suburb.
Yeah.
And you want debt for it. right? Because whatever cash you've been getting, you've been putting that back into the business to buy supplies, pay your staff, your own personal expenses, paying yourself.
Yep.
So you need debt for that. And the banks might consider you a bit more safer because you've been in the industry, you know the challenges, you've been running your cafe.
Yeah.
And the interest rate, that will reflect on your interest rate.
Right.
And then part C could be, you could be a business that's been up and running for about 10 odd years and been profitable year on year. You've accumulated your retained earnings over time. You accumulated assets over time. You've got a good market reputation. You've got goodwill. And that's all reflective in your business cash flows, right?
Right.
So from the bank's perspective, you're a safe line.
Right.
They will love to borrow you money. And obviously, you've got assets to back it up. So the interest rates will be reflective of the rates that basically banks are taking.
Got it.
So if you are in part A of your business journey and you expect to get interest rates or same treatment as part C,
right,
you're not bank ready yet. You have to be bank ready.
Interesting.
Yeah.
Okay.
So being bank ready takes a bit of advice, but takes a bit of time as well.
Yeah.
So you need to understand like what sort of cash flow projections. You've got to comfort the bank in a way.
Right.
You've got to convince them.
Is there an element here? And I know we're going down rabbit holes, which is great.
Yeah.
There's going to be a few of those today. Is an element here of ultimately you're a very large and established business, or just a well-established business, doesn't have to be large necessarily, is going to end up with most likely bank funding for their debt needs, just because that will ultimately most likely be the cheapest form of funding. But a vast or a big chunk of businesses can't start there.
Yeah.
They have to start where they are, right? If they're at inception stage, someone's lending to them on a promise or a prayer or with a bit of security, and maybe that's coming from a bank, but it's most likely coming from some other source.
Yeah.
So, as I said, we'll get into some of the exact products and some of their uses a bit later on. But let's talk a bit about some of these sources, because obviously the banks lend money. In fact, when we think lending, we tend to think the banks.
Yeah.
And it sounds like you're saying that the banks are 100% there, but they tend to be later in the game for businesses. Like, who are the other players? What's the market look like in terms of availability of funding and options?
No, great point. So banks, if I touch on the core data, so for anyone who's a bank is an ADI, that's an Australian deposit taking institution.
Yeah.
So they've got a license to collect your money, right? Store it, like keep it in a safe way or follow the principles.
Yeah.
And then use that money to borrow to other lenders or people who want to sort of get debt in the market. So those are ADIs. Those are your major banks and their subsidiaries: ANZ, Westpac, NAB, Combank, Bendigo, and their subsidiaries like Suncorp, Bank of Queensland, and so on. And then you've got non-bank institutions as well,
Sure.
which is a sort of Pepper, Bluestone. So they're not ADIs.
Right.
They haven't got they're not
They don't take deposits. Yeah.
take deposits from clients, right? But they're able to raise deposit or raise money to the investors they sort of go out to.
Sure.
So they get into riskier transactions. Could be high LVR. Could be someone with low doc servicing.
Yeah.
So they're able to source funding. They tell their investors, look, we can give you 5% interest rate back on your investment, and they borrow that same money out at 8.59%.
Got it.
Right, and that's the premium they charge for the risk they're taking, for all the assessment, and so on. And they're great for businesses that want to grow.
Right.
That businesses that are not bank ready, either in terms of LVR or in terms of cash flows, unsecured debt, and stuff like that. So before you are bank ready, as I mentioned before, these are great companies or great organizations that help you get to a stage where you're bank ready, you've got some assets, you've got like a proof that you can run a profitable business, and then you can move on to one of the banks.
Right.
But banks necessarily are not cheaper or always cheaper than these organizations as well.
Oh, okay. So it might depend on your stage, obviously, but also how you like present to the bank or present to the lender generally. It's not just, hey, it's always going to be a bank that's cheaper than a non-bank lender, for example.
Exactly.
And then just completing the picture of the types of players that are in the market. So banks, non-banks, there's this kind of emergent category of, I don't know, fintechs, I guess.
Private lenders that are coming through.
What are those? Sorry?
Private lenders.
Private lenders. And so, I mean, are they kind of under the umbrella of non-banks, or are they a category unto themselves? Are they just even further along the risk curve of, like, is that kind of where they play?
That's an interesting point, I think, because in Australia, especially after post-COVID, if you're someone who's sitting with a lot of savings, right, and we've got a lot of older population in Australia as well, the returns they used to get on their term deposits, fixed deposits, and savings account dropped down drastically.
Right.
right? So while it was a blessing in disguise for the homeowners because we were able to borrow money at 1.5-2% interest rate, but people who were sitting on deposit for their retirement funds,
Sure,
they were hit badly because they could not get the same rate of return they used to get back in the days,
sure,
right? And a lot of people who are less risk averse in a way, so they reached out to like the lending organization or private lenders reached out to them and said, look, if you invest with us, we lend out money to property developers, we do asset finance loans, we do property development loans,
yeah,
and business loans at a higher premium because they're riskier transactions. But your rate of return as a bank is giving you 2.5% on your savings.
sure,
Will probably give you 6 or 7%.
right,
So that led to a rise of sudden surge in the private lending space as well, where all these companies that are sort of the middlemen of they're basically peer-to-peer lending, but they're the middlemen.
got it.
So they're getting money from you,
Yeah,
doing all the assessment in the background and passing on the money to me, and they're charging a premium and paying you interest.
and so like if you bring it back to I'm the business owner and I'm maybe quite early on in the business, or maybe I've been in business for a year. I mean, use the example of the coffee machine. You know, the beans provider gave them a cheap coffee machine that doesn't work very well, and they're like, we're a great cafe, but we need a proper coffee machine. I'm probably throwing a coffee roaster under the table there, but anyway, point being is that a business owner who thinks, well, if I need money, I go to the bank because the banks have money, is missing an opportunity to actually solve the problem that they might have or create an opportunity. Because if they're super early in the stage and the bank says, you're not for us, you're not bank ready, to use your term, and they think, well, that's it. That's my option.
I can't run my business. That's it.
Okay, well, that's, save enough money every day and then buy the machine outright 7 years from now.
Yeah.
Your primary message here is don't consider the banks as the complete view of the market, especially if you're super early kind of in the piece.
Exactly.
That's right. Okay. And so on the private lending side as well, though, they're, as you said, they're essentially taking money from investors who are looking for higher yield or higher returns on their money, and then understanding the true risk of an earlier stage business, and then lending it out, obviously at a margin, which is how they make their money and everyone gets paid. So the critical thing that seems to come out of that is that banks, at that stage at least, may not be so close to trying to understand the business and whether it's going to be a good business or not. But the non-bank lenders and these private lenders are prepared to do that. Like, what's actually happening? Like, how do you connect the dots between that business and one of those private lenders or non-bank lenders?
Right. So private lenders, typically, like you got to look at it, most of them as asset-based lenders, right? So if you got a property and that's got equity sitting in the property, but your cash flows are not proven yet because you're a new business, right? And there's some risk involved with the confirmation of your cash flows, which you think you're going to get in a year's time, right?
Sure.
And the private lenders come into the picture because they can use your asset as a security. That sort of gives them the confidence for you to borrow money to you.
Yeah.
And with the cash flows, they're a bit more lenient, and as compared to the banks, right? So they deem your cash flows and like, yep, meets your criteria. They can do certain things like remove the buffer rate, increase the term of the loan. If you're acquiring a new property, for example, or commercial property for your premises, they can extend the term of the commercial property as well. They can structure the loan in a way that suits you better,
right,
or meet the lending needs. So a bit more flexible or agile in terms of their lending principles and the structure.
Got it.
Banks are not, because they are governed by certain principles they have to follow. They have to apply a buffer rate on your lending. And the banks are getting a bit active in this space as well. There's a lot of banks that are doing lease dog or low dog loans as well.
Really? Okay.
Yeah. So for newer clients,
what did you say, lease dog? Is that the term you just used?
Yes.
Oh, lease dog. Okay. So I know low dog. What's lease dog?
So lease dog is primarily if you're a commercial property investor.
Got it.
Right? And your yield for your property, you got enough servicing coming into the rent of your commercial properties. Sure. So the bank, and if that justifies the ICR or the interest cover ratio, so the bank says, look, your interest for the year is going to be $100,000.
Right.
Right. And your rent is $180,000 a year. So the rent divided by interest is 1.8.
Right.
That's a go. Well, we don't need to.
We don't need all the rest of it.
Yes, we don't need to worry about your living situation, how you're doing in the background, what guarantee, like guarantors, income assessment, living expenses, none of that.
We've seen a lease. It's a 5-year lease.
That's it.
It's McDonald's warehouse who has the lease, so we trust the company who's going to be running it. Interesting. Okay.
There are certain things involved with that one. For example, working WALT, which is weighted average lease term, that will dictate the term of your loan and so on. So it's not. I mean, it's they simplified the lending part a little bit better. Because, for example, back in the days, if you want to refinance your commercial property over, They'll look at you as a guarantor, do a servicing assessment for you. They'll ask for your income, your living expenses, and then assess the whole consolidated financial for you as a family and as a business.
Got it.
But they got a bit more lenient because they got to be a bit more competitive in the market.
And so, bringing this back to kind of a business owner who is trying to unlock some part of their business. Let's take the example of they need another commercial property or they want to grow because they need to build more stuff. So they have a business. They don't have $1.8 million lying around to buy, a warehouse somewhere in Mickleham, or I don't know. Is that right? Is that an industrial part of Melbourne?
Oh, yeah, it is.
I guess that's roughly right.
That's close to the airport.
Close to the airport. That's where I was going with that. I kind of see that side on the way to the airport. All right. So they don't have 1.8 million lying around. They're going to be the company making the lease payment, but or maybe they're going to have whatever it is they're going to do. 20 years ago. Or maybe not even 20 years ago, you tell me, it would have been fairly limited. Go to your bank manager, talk to your bank manager, and hopefully the bank has a product and you fit into the product and that's the end of the story. Fast forward now, obviously, I actually did this last week. I found out there's 124 banks, I think it is, in Australia. So there's a ton of banks if you just stay in banks. But there's probably that and as many again in non-bank and private lending. So it's not to say there's always a solution, but there's probably someone who has the appetite.
Yeah.
If it's a legitimate need, right, backed up by a legitimate business, if you don't fit the bill with Bank A or Bank B or Bank C, even non-banks D through Z, and then private lenders. So, has the problem become almost harder for a business now because of this? Because, how do you have gone at 100 conversations?
That's a great point. So, look, If I was working for example, one of my clients back in banks, right? Let's say an institutional client was looking at acquiring a new business or buying a new property.
Sure.
And this comes to the major banks and we have to do a full assessment on the whole scenario and this and that. So what we'll do is we'll work out a hurdle rate. Are you familiar with the hurdle rate?
No idea what that is. I feel like I should know this stuff, but commercial lending is very new to me. So
right.
Yeah.
So it's more of a corporate finance principle. So for example, if you're looking at buying a commercial property, for example,
okay,
right? And you want to buy the property, you retain it for 10 years, make some capital gains, possibly earn positive returns on the property over the 10 years, and offload it, sell, make some profit, right? That's your goal.
Yeah.
And let's say the property gives you a 5% yield, right? So the return on property on your purchase price is 5%.
Yeah.
Let's assume that's net after paying all the outgoings and land tax and all that. Yeah. And your interest rate is 6.5%.
Got it.
So you're negatively geared now. Right? You're negatively geared by 1.5% off the purchase price of the property.
Right.
So you're going to get some money out of your pocket.
Yeah.
To meet the lending requirements or the loan terms for the property.
Sure.
Right. But in the long term, because the commercial property rents do go up by a certain inflation percentage year-on-year basis, and that's compounding.
Yeah.
So let's say in 5 years' time, it comes to a break even, assuming your interest rates stay the same. So you started $100,000 as rent,
sure,
year one.
Yeah.
Next year is 4% compounded, so that's 100,000. Yeah, 104.
Yeah.
And so on and so on. In 5 years' time, you realize it's $135,000. Hypothetically, I haven't got my calculator, but let's say let's assume that's true.
Yeah.
Now your purchase price was fixed in time when you bought it for $1 million.
Yeah.
That's what it was, right? But the rent has evolved over time.
Right.
So if a negatively geared property could have become a break-even or a positively geared property as well over time.
Mm-hmm.
Right? Because the rents are now good enough to cover for the interest and so on.
Yeah.
But your lending rate, you're negatively geared because your lending rate was slightly higher than the yields on the property.
Right.
Right? But in the longer term, that breaks even. And in 10 years' time, you get capital growth out of it and you walk away with some profit.
Yeah.
Now, a good lender, for example, if I was assessing this application, I'll do a cash flow analysis of your 10 years projections.
Yeah.
Put that as time value of money. I'll say, so 10 years of rent payments, and at the end of the 10 years, just like a bond, there's going to be a payment that you'll sell the property and you make 1.2 million out of it.
Yeah.
What's that worth today? Right. So let's say you were selling it for 1.2 million, but today's cash flow discounted to today's time, you probably get 960 out of it.
Right.
It's a bad investment.
Got it.
Right. I'll probably ask you to walk away from it, but you're like, Nick, I'm going to make $200,000 in 10 years' time. And I'm like, well, your cash flows are negative for the first 5 years.
Yeah.
You're probably going to be positive in the next 5 years.
Yeah.
And if I take out like discounted by the rate of return and inflation, you probably going to make a loss on this.
Right.
Right.
And then is the benchmark rate changes based on the bank's view of you, that therefore means that they change their perspective? That's where the benchmark rate comes in?
It gets a bit complicated there because we look at the yield curves and see what's the average, like what's the 2-year bond rate,
right?
10-year bond rate, what's the expected average rate of interest or rate of return for the entire journey of 10 years. Right? And nobody knows that, right? We just look it up.
Everyone's making it up. So,
yeah.
Well, I mean, everyone's crystal ball.
Exactly.
Yeah.
Right. And if you put some money of yours in that, so there's a WACC, which is a weighted average cost of capital. We put that. We look at the cost of equity, which you're bringing in, cost of debt, which you're borrowing from the bank.
Yeah.
We'll assess it and see if this is is this going to be a positive cash flow? If the rate of return from this investment is more than the rate of weighted cost of capital.
Sure.
If it's not, it's poor investment.
Right. And so, we've gone down into a bunch of detail on a particular type of thing, in this case, buying commercial property. Is this how banks, non-banks, and kind of fintechs would all look at this? Or banks kind of look at this level of rigor, but the non-banks might just say, the asset's great, the cash flows are good. Yes, there's a shortfall, but we have, happy with that risk position. I guess there's two questions I've got. One is, will all these different providers look at this kind of in the same way? And secondly, it sounds like for some of these commercial kind of lending scenarios, the bank is almost wanting to do the same level of financial due diligence that they would expect you to do as to whether this is a good investment decision at all. Is that correct?
Well, to some point, look, for example, the example I gave you right here is probably more for a bigger bank client. For example, if they're buying a property that's worth about 20 million, 35 million space,
right,
they'll probably do a WACC analysis or cash flow analysis, or the government will do it if they're considering building a project.
Sure.
Like a train lines, and they work out the cash flow that they're going to make from this train lines and so on. They'll probably look at this analysis. Retail customers don't have this advantage. Banks just look at their serviceability as of today.
Right.
They don't work out their cash flows.
Sure.
They don't work if this is going to be good or bad investment for you, because you're on your own. You're taking the risk. Right?
Yeah.
And because they want to walk away from the risk, they get you to put 30% deposit. Right. Even if it's a bad investment, right, you don't make any money out of it, they get their 70% back anyways.
Yeah, right.
So you need to engage with someone who's a bit more professional, gives you advice,
and
helps you build that strategy. And that could be your broker as well.
Yeah.
And I think that's where my expertise comes in. So my client will, in the bank as well, I have multiple clients acquire commercial properties or a bunch of commercial properties, and that's where the value comes in. I'm like, so they come and tell me, look, I'm buying this commercial property for investment. I'm like, great, but what's your rationale behind this?
Yeah, what's your investment thesis?
Yeah, it's like in 5 years it's going to make me $200,000. I'm like, the time value of money, do you think it's going to be worth the risk? The risk you're taking, the level of debt you're taking.
Yeah.
Is this going to be a positive cash flow? And they're like, well, never thought of that. And who does this analysis for me? It's like you can go and hire someone and pay thousands of dollars. Or I've got my own spreadsheet, which I help my clients with.
Yeah.
And I'll be like, yeah, this is how it's going to look like.
Yeah.
And the same thing could be traversed over to residential property acquisition as well.
Yeah.
So if you're buying a residential home, purely as investment, not a home, but investment property, and expecting a rent for a time period of 5 years, we can work out exact cash flows. And if you're going to offload that in 5 years at a certain price, and I use the binary tree approach.
Right.
If this, if that.
Right.
So that's the best case scenario price and the worst case scenario price. So what's your break even price that you make no profit out of this? And trust me, a lot of residential property projects, especially because they're front loaded.
Yeah.
Stamp duty up front and all that.
Agent fees or whatever.
Yeah. You think you're making money.
Yeah.
And they're front loaded and they're back end loaded as well, because you do pay capital gain tax in the end.
Sure.
And they all sting you. And if you do a cash flow analysis of your returns, you're like, shit, I'm losing money on this one.
So, I want to come back to home loans in a sec, because it feels like it's an entire topic related to a business owner. So I want to make sure we get into that into its entirety. But coming back to this idea that at the point where you're a business owner and you have a financial decision to make, right? And that financial decision includes some form of debt. So we use the example of a commercial property, but it may be something as simple as buying the coffee machine, and we can have 4 heads instead of 2, and it means I can hire an extra person.
Exactly.
And so now we're doing 70% more coffee, but we've got the added cost of the person and the coffee. So there's ultimately a financial rationale for this thing, and then there's a debt component to it. Now they're linked, but it sounds to me like part of why you're, a business owner, should be talking to a commercial broker, or at least one who's worth their salt, is so that you can actually navigate and talk through some of this stuff as part of considering the debt aspect, but also should you do it at all.
Yes.
And when you work with commercial clients, and I know you've worked with a whole spectrum, right? From early stage businesses through to people with, I mean, you told me like 20 something properties or something. Like some big commercial one. I can't remember the detail. Yeah. At some point, there's a maturity in the business where they're like, we have a finance person, and they, craft up all the numbers, and you're almost talking to an educated audience.
Yeah.
But for I guess for an overwhelming majority, I mean, the person baking bread is not a CFO.
Exactly.
And so it's when you're talking to these clients, there's a lot of what you're doing, bringing not just the expertise of how to secure the debt, but also just how to navigate the financial decision.
Yeah.
And how does that, like, in practical terms, we're getting into a bit of detail, but how does that look with a client? A client rings you up and sort of says, hey, here's what I've got, Nick. What do you think? And you're like, dude, like, we're going to have to look at some stuff. Like, how does that actually look in practical terms?
That's a good point. It's a great question, Vincent. So, look, I end up talking a lot of my clients out of buying businesses sometimes.
Really?
I'll say that because I'm very risk averse myself.
You're the Mr. No.
Yeah, I'm Mr. No. And because, like, working in the bank, the strategy or the mindset that I've acquired over time is just being so risk averse.
Right.
You hope for the best, but at the same time, you're like, what if the worst happens? COVID happens, right?
Sure.
Interest rates go up. I know my friends who are buying property left, right, and center. My clients who are buying properties at 2.7% yield, commercial.
Right.
And I got a customer of mine, I wouldn't name him. He acquired 3 properties, and I was working as a banker for him. I'm like, these are super expensive, and your yields are like 3%. It's like, I don't care. The commercial rates are 2.5%, 2.75%, so they possibly care. And I told him, like, if you look at the yield curve, at some stage, the interest rates are going to go back to 5, 4.5, 6, 7% for the commercial rates, right? Yeah. Have you got a strategy for that? And he's like, well, I'll see. Like, my property is going to go up in value, and I'll sell the property. It's like, well, the correlation is intense because the moment the cash rates go up, the property value is going to come down too.
Right.
So you won't get a top price for your property either, because whoever's buying this property at a higher yield, a higher interest rate, would want a higher yield as well.
Right.
Which means a lower purchase price.
Right.
Didn't listen. He acquired those properties, and he used to own a expensive house in an affluent suburb in Melbourne. So I spoke to him a year later. No. Yeah, but he had to rent it out through that was getting him $50,000 a month or something, and he had to move away to a different suburb himself because he's like, I just can't keep up with the cash flow deficit. Yeah. And I tried selling my property, and it's just not the price that I thought it's going to be.
Well, he's going to be underwater, probably.
Yeah, exactly. And it met the appetite because it did qualify the bank's lending criteria.
Right.
Because the interest rates were so low, right? And the banks do apply a 2% buffer.
Yeah.
So even at 2.7% interest rate, which he was getting for the commercial loan, plus a 2% buffer was 4.7.
He's got a 5% yield or whatever.
Exactly. And then he was like, he met the criteria, but 3 years fast forward, when the commercial rates were 7.5%, plus a buffer of 2%, he wouldn't meet, he couldn't even refinance at 9.5% assessment rate.
Right.
So he's basically just stuck.
Yeah.
And I talk about this, and I'll stress this in the later part of the conversation, the refinance risk.
Yeah.
The home that you're buying today at a cheap interest rate and paying a top dollar for it, 2 or 3 years later when the interest rate go up, and you have to refinance it or restructure it or do something about it, you're probably not going to do that.
Yeah, pay for the not the worst case, but you got to consider, you said before, you got the best case, worst case, likely case scenario. Just coming back to kind of the practicalities of how you're doing that. Obviously, there's a lot of dialogue there. Are you interacting even with a business at the other end of the scale, the smaller end of the scale, with the accountant, or like you getting into the bank details? Like how in that early stage, obviously later you have to get everything, but in the early stage where someone's thinking, hey, I'm thinking about doing X because it'll give me upside, or I'm stuck here. So are they like, what's your dialogue? Is your dialogue down in the bank details and with the accountant? Like, you in that level of detail early on?
Not true. Unfortunately, I just finished my MBA.
Why is that unfortunate? That sounds like a good thing.
Yeah, I've got more risk averse after that. Right?
Oh, right. Okay, right. You're more risk averse.
I'm like a heavy quant-sided person. So, I mean, look, if you're sitting across the business and you tell me, Nick, I've got a proposition, I want to acquire this piece of land, keep it for 5 years, subdivide, sell, build warehouses, and sell it in 5 years' time, great. That's awesome, right?
Right.
And my question would be, show me the numbers. And you'd be like, yeah, well, here's my projections. I get it. Like, this is probably the best case scenario. You scale that down to 80%. That's probably the worst case scenario from your perspective.
Yeah.
My worst case scenario is a bit different. Market shift, there's an economic change.
Right. Planes can't fly for 6 months.
Yeah, exactly.
No one's allowed out of their houses.
Exactly. And that has happened, right?
Right.
Yeah.
Yeah, recently.
Yeah.
In recent times. And okay.
Yeah. So my worst case scenario is like, well, okay, that's fine. Let's work let me put my laptop up and bring my Excel sheet.
Yeah.
And we'll put the numbers in. We'll do a cash flow analysis. We'll get your hurdle rate worked out. We'll see what sort of returns you need to get minimum.
Yeah.
In like, for example, if you're going to offload the property in 5 years and make X amount of profit, what's the minimum profit you need right now in a time series or value that sort of does the break even for you?
Yeah.
And if you meet that and you're pretty confident you're going to do that, we'll talk about it further.
Okay.
If not, maybe, I can probably get you the funding.
Yeah.
But how are you going to be in 2 or 3 years' time or 5 years' time? Are you going to be in a worse position than you are today? Are you putting in your capital, because you got to put a 30% or 50% deposit through this transaction? That's your equity.
Sure.
Are you going to end up burning it?
Yeah.
And this has happened, right? I know a lot of construction companies, a lot of property developers in my time in the bank who've gone bust just because of cash flow. Very asset rich.
Right.
Apartment projects halfway through, 75% complete. They haven't got money to pay their builders or contractors for next month. And they just...
That's the end of it.
Yeah,
and as soon as it's near the end, no one will, that thing about how debt, you have money and then suddenly you don't.
Yes.
And I think I can't remember the quote. There's a really good quote about it. And it sounds like that. All right, cool. So I want to get to home loans, but before... because I think that there's an interplay for a lot of business owners between their business and their home loan and probably their business debt. But before we do that, I want to just touch on maybe the 3 or 4 big kind of commercial or business-led products. So we've talked a bit about commercial lending to buy a commercial property. Give me a sense of the other 3 or 4 products and the problems they tend to solve for a business owner.
Right. One of the products I really and I know a lot of the business owners will know about it, is the short-term funding for invoice financing.
Okay.
There's a lot of companies out there. So for example, you've got cash flow issues, right? You've got invoices issued. You've issued invoices. You're expecting money to come in 30, 60, 90 days.
Yeah.
But you haven't got cash to meet your cash flow for the next month or this month, right? So there is invoice financing out there, and the interest rates might be slightly higher, right? But it's only for 30 or 60 days.
Right.
It doesn't impact you as much, but a lot of people that go through a challenge in the cash flow end up going to the bank and getting a longer term loan for 1 or 2 years, 5 years, because they have to meet the serviceability assessment.
Right.
So if you go to the bank, and banks do have invoice financing division as well, but you don't talk about that often with your banker.
Right.
You just call them and say, I need $60,000 to go cash flow issues, and they're like, yeah, servicing looks for you.
Sure.
But if you dig deeper into that one, right, if you structure it right, you go to an invoice financing company and say, look, I need funds for 60, 120 days, and I'll pay it back in that time frame. And even if the interest rate's 10, 12, 13%, if you work it out, and that's annual.
2%.
Right, exactly. That's nothing.
Oh, not even that.
Yeah.
Is that so? When someone says invoice financing, is factoring? Is that the same thing, or is that something else? I hear this term factoring occasionally, and I think it's invoice financing, but I don't know. Maybe it's a US term. That's something.
Could be.
Okay.
I think it's more UK.
A UK term.
It's a UK term.
Okay, that actually sounds right. I think it was a UK guy in the US who told me that term. I'm like, that's what I've been calling it ever since. Okay, so invoice financing, cool. Yeah. Bucket number 1. What are the one or two kind of key products?
Also, there's asset financing as well. So if you're a business that does, for example, I've got a business that I'm dealing with right now. They do a lot of excavation, piling, construction, and all that, and they do buy a lot of machinery every now and then.
Right, replacing machinery, or $200,000 to fix this damn thing.
Exactly.
Probably shouldn't say that, but yeah.
Scaffolding and all these equipments as well.
Right. So.
And they've been using their home equity to get a business loan.
Really?
Yeah. So they got a business overdraft, and they use that overdraft to purchase the equipment, and there's just this money is just that's there forever at a high interest rate. I'm like, well, you can easily get an asset finance, and then easier way for you. It's structured, which is tied up to the duration of your asset.
Right.
So if your asset's worth about 7 years, useful life of 7 years, the debt's 7 years as well.
Right.
So you haven't got a debt that's sitting there for 20 years for an asset that was only useful for you for 5 years.
Got it.
Right.
And that's important for tax reasons, or for just good business practice? Like what?
Yeah, because the amount of interest you'll end up paying for 20 years is pretty high.
Right.
B, it will impact your cash flow, because if you have an asset, you just want to pay it off in 6-7 years, get the depreciation benefit out of it, and just move on. Maybe you want to replace maybe you have replaced that asset 5 years down the line, but you're still paying for its debt 15 years later.
Yeah, got it. Right. And so asset finance, equipment finance, same term, same sort of thing. Okay, cool. So you've got an asset. My understanding as well that if you want to, often it's about moving quick. Let's take the example of someone doing the foundations and piles. Suddenly wins a contract with Mickleham Council. We're going to keep going back there. I've probably used them all up. I can't even pronounce it correctly. That's probably why I should stop using it. Am I saying it right? With apologies to Mickleham. So, he wins a contract on Friday, and they're like, great, you start Monday week.
Yeah.
And so he rings up whoever makes, pile machinery.
Yeah.
And they're like, no problem, we've got them, they'll arrive by Thursday. You need $180,000.
Yeah.
And you're not getting that off your home loan. Very rarely would you be able to pull that money off your home loan. So it's part of its speed as well, right? Like how quickly can we move?
Yes.
And as a business owner, again, you're looking at a financial decision. We've got this $180,000 machine. We're going to be hooked up for 6 months. We're going to make $290,000 in that first 6 months and then get more clients after. So the cost of capital is important, but the ability to move quickly and solve the problem, unlock the business opportunity is the other factor.
Absolutely.
All right, so talked about invoice financing, talked about equipment finance, we kind of talked about commercial. Any other buckets that kind of sit in there?
I just want to touch on that. Like, it's a great point that you mentioned that. I think from a risk perspective and for your own accounting purposes and cash flow analysis, the debt should link up with the asset that's tied up too.
Right.
So if you're buying a truck, there should be a term of the loan that should match with the useful life of the truck as well. There should not be a 30 years loan.
Yeah.
In general, if you're buying a house, that's a long-term asset that could stay in for 30, 35 years, and that's what the banks do, a 30 years loan.
Yeah.
If you go to a bank and say I want a car loan for like 20 years, they probably won't do it.
Right.
Because they link it up with the useful life of the asset you're acquiring as well. And so should you, because it's a very useful practice.
Yeah.
It helps you. Imagine yourself having 50 different machinery items, right?
Yeah, all on your home loan.
All on your home loan, right? No, you're all on a 20 years term. You're just paying interest like left, right, and center. If it's tied up with 5 years and this is the loan for this equipment, right? Am I selling this equipment? Yeah, I'll pay off this loan.
Right.
It's a better packing of in terms of your accountant's going to love you as well.
Yeah, yeah.
But it's just an easier way.
Yeah.
Right.
It's just as an aside, you've got if you have a home loan, right, and you get it, and it's originally they give you the minimum monthly repayment and it pays off over 30 years.
Yes.
Now, if you get a credit card and you pay the minimum repayment on a credit card, guess how long it takes you to pay off the credit card?
No, it'll take forever.
30 years. I feel like they've worked out that that's the longest they can reasonably make something paid off, and so credit card minimum repayment is literally as bad as having a home loan, except that it's 22%.
And that's assuming you're not spending any much.
No, it's just paying off the debt you've already got.
Exactly.
All right, so before we get onto home loans, because I want to talk them in a separate category, if we're just talking about, we've done a commercial, we've done invoice, we've done equipment finance. Is there any kind of other bucket of lending, like where do overdrafts and things like this fit in, like things relating to not cash flow, but like the machinations, the working capital? Like, what's that bucket of funding and debt look like?
No, great question. Look, overdraft is for example, you're running a business, right, and you got invoices coming in. Your invoice days on hand, for example, is 60 days. So, and you work out your cash flows. You're always like this. You just realize you're sitting on your accounts and you're like, this certain part of the year, I'll go off surplus funds sitting in my account, and this certain part of the years I'm just bleeding dry, right? Why is this happening, right? And then you go to off your business is seasonal, right?
Yeah.
So you're running a cafe in a coastal town that picks up during summers, and all of a sudden you're cash flow positive, but then you got the rest of the year to go through, and you're struggling to pay your rent and stuff like that. So overdraft is a great option for you because you've got that surplus fund sitting there, and if you're not using it, you're not paying for the interest for it.
Right.
But you can't rely on it forever. So you can't have $500,000 overdraft sitting in there and using the money to buy machinery or acquire a new coffee machine and stuff like that. It's just for your purely cash flows.
Got it.
Right. And then you can back it up. A lot of banks do it these days. So for example, if you're a major bank's customer and then they have your financials, zero MIOB, they'll probably give you an overdraft straight away.
Right. Without
needing a security. But it's going to be slightly higher interest rate. But obviously they can use the equity of your property or for your home loan and guarantee the overdraft with the asset and bring the interest rates lower.
Yeah.
So it's just purely for working capital and cash flow purposes.
Got it. Okay. And so if I recap on that, but it's also a great segue to home loans, there's various types of financial products and they're designed to solve a particular problem that you might have. And often those problems will exist at all stages of a business, but you tend to see certain issues at certain stages and certain other issues or opportunities at other stages. And so part of this is also about not just thinking through each decisional problem or challenge point as a financial decision to be made and therefore understanding the numbers and running those properly, but also knowing what's the right tool for the job and then who's the right provider for that tool to either get it quickly or to get you the outcome if someone else won't get you the outcome, or multiple people will give you the outcome. Let's find the cheapest cost of capital because don't pay more than you need to.
Yeah.
And so if you had to throw yourself as a broker into that, it's like any and all of those things, Vincent, is kind of, where it sits when you have a relationship with a broker. It's not, hey, come to me when you have a need for finance. It's come to me when you have a problem or an opportunity in your business, and then we'll work out what's the right tool for the job and how to get it done.
Yeah.
Cool.
That's exactly right.
Beautiful. All right. So back to that arc. We're now in home loans. So I want to talk, I was interested to talk about it as a separate category because I think, firstly, property is sport in this country. And so as a business owner, you invariably are going to want to make investments in property or have a home to live in, God forbid.
What else are you going to do in this life? You're going to invest in ASX or shares and all that. The return's pretty shit anyways, right? So
well, it's funny. Like, I think if you talk to a stockbroker, they'll tell you to buy shares. And if you talk to a real estate agent, they'll tell you to buy property. I think both can help someone with whatever they're trying to do. Nothing of what we're talking about is financial advice, obviously. But assuming that you want to live, you're going to ideally live in a home that you own for most people. Firstly, without talking about home loans, because we can talk a lot about home loans, but I'm really interested in the intersection of a home loan and a business. So you're a business owner who's running a business, and you've got some debt products related to your business, and now you either want to buy a home or you've already bought a home. Help me understand kind of how those things coexist. What does it look like to do it well, and what are the mistakes that people tend to make?
Yeah. That's a great point, and I've actually got a chart on my laptop I want to show you.
Sure.
I'll just talk through it.
Yeah, no problem.
So I'm trying to narrow down on what are the different stages or what are the different scenarios that a business needs debt for, right? There's a lot of scenarios from my experience that a business needs money for.
Yep.
They just sort of acquired a new business, right? They just sort of started their new business. They need funds to sort of start it, buy the coffee machine, pay the fit outs, pay the lease in advance and so on. And then they would want to use the equity on their home loan because it makes it easier. The interest rates are sharper. The banks tend to be a bit more comfortable having the security linked to the debt as well.
Sure.
Right. So it gives the bank a bit more comfort.
Yeah.
Right. And because it's linked to your property, and that's why I used to tell a lot of my clients, if the banks decline your loan, it's probably a good sign you're not starting your business because the banks are deeming it risky.
Right.
They do a top-down approach. They look at the industry as a whole. So if you want to open a new gym, for example, and the banks from the experience know a lot of gym are shutting down because it's not turning out to be a great business, right? So they'll be a bit more skeptical. They'll investigate this further.
They have better data than you might.
Yeah, exactly.
Because they have most of the gyms in that area are their customers, or at least enough of them are to have data points about how they're going.
Yeah, and there are gyms, a lot of gyms in your area or your state or your territory is having insolvency issues.
Right.
They will put they'll come on the radar from the bank's risk perspective, and they're like, we don't want to borrow money to that.
Yeah.
When I was working for one of the banks just after COVID, there's a lot of retail customers that I know of, the retail clients of mine, who were cycle shops.
Yep.
And the cycle business seemed to have picked up a lot during COVID. A lot of people were buying bikes and stuff, right?
Yes, middle-aged men or just people in general?
Just people in general.
I read an article that was a lot of middle-aged men.
Middle-aged men are buying Harley Davidson these days.
Oh, is that what it is? Okay. I need to keep up as a middle-aged man. But sorry, continue.
Yeah, exactly. So, and a lot of these people, they were importing bicycles from China. Hong Kong is a great market. They were importing a lot from Hong Kong, right? And they were overstocked, thinking this demand for bicycles is going to carry on forever.
Right.
Next a year forward, 6 months forward, 2021, second half of 2021, I think is when the lockdown sort of eased up a little bit.
Yeah.
Gyms opened up with obviously restricted number of people in the gym and so on. The cycle sales dropped tremendously.
Right.
And then you still have clients calling up and say, I'm looking to start a cycle business, want to get into kids' bikes and stuff. And we're like, well, we've got industry outlook and we don't think it's a great business idea right now because A, there's a lot of competition, B, there's a lot of people out there who was talking bicycles.
Yeah.
There's going to be a price competition.
Yeah.
And from their perspective, they're like, the bank, if I'm alone, I'm going to go and get money from elsewhere. But look, I was like, we're doing you a favor.
Right.
We're telling you a free scenario, do not get into this business. It's not doing so well.
Yeah.
Right. So that's what I tell people. If the bank assesses your commercial property acquisition or your business acquisition, or if the bank tells you, no, you should not take any more debt, they're probably helping you.
Yeah. They're coming from a place of there's information asymmetry. They might know more about
that's exactly
than you might. And obviously the inverse is potentially true. You might be the best bicycle shop operator and they just don't know that yet. I just want to come back to home loans though, because we started with if you wanted to run that business idea, you might just pull the money out of your home loan. And, there's some advantages in doing that. You might have cheaper cost of capital.
It's going quicker.
Get it done quicker, maybe, or depends on what it is, I guess. But assuming, you've got this property, you've got this home loan here, or you don't have a home loan and you don't have a property and you're wanting to buy one, like, I'm still kind of keen to understand, like, how intertwined do these things get, or should they get, or is there an argument to kind of keep these things arm's length? Like, you don't want to be in a position where the success of your ability to live in your home depends on the success of your business. I guess it does anyway, but, like, help me understand that balance a bit more.
Yeah, right. And it's a great question. I'm not sure I've got an answer for that, because a lot of businesses, especially small businesses in Australia, they do they use equity from their home loans. And that's why when the OCR, or the official cash rate, as we discussed, that goes up, right? And all the lending rates go up in general, small businesses tend to suffer quite a bit.
Right.
Because they use their home property as a security to get the debt for their business, right?
Sure.
So, which is what happened in the last 1 or 2 years, right? They are impacted by the home loan rates.
Mm-hmm.
So in terms of, if they don't use their home as a security, it gets pretty hard for them to get debt to start their business as well.
Yeah.
So they are sort of intertwined, right?
Yeah.
But I think one of the good parts, the thing is, like, once you have your business equity, or, well, to be honest with Vince, I'm not sure how to answer that. Like, it's this the risk the business owners have to take.
It's like, and it's good. Like, it's not to say that there is, like, one definitive answer. And I think the answer, by the sound of it, is that, it depends. Like, A, it depends on where your business is up to. B, it depends on your risk. And look, part of this is me projecting. I had an early stage company, a startup. I don't really like the word startup, but I had a startup. And I also owned an apartment in the Finger Wharf in Woolloomooloo in Sydney, which, if you know Sydney, like, that's primo. Like, what's his name from Gladiator?
Yeah. Russell Crowe.
Russell Crowe lived at the end of that building.
Oh, wow. Right.
It was like A-list building. I didn't have a Russell Crowe apartment by any measure, but I had this thing, and I bought it cheap in 2003 or something.
Right.
And in my head, I conflated the two. I always thought, well, if that thing's there and if I want to do a business, I can just, take money out of that thing or sell that thing and then pay for this business and happy days. And I wish someone had been sitting on the shoulder saying, dude, keep these things separate in your mind. Yeah. Because part of it is your business, and your business can, if your business doesn't work out and it, or takes longer, which is what's true, which always tends to be the case, you've got some diversity, and these things aren't tied to each other. I didn't borrow money against it. I just sold the whole thing and threw into a business. And obviously I probably could have just done better financially, just holding on to the property and doing business, but accepting that the business had to stand up on its own 2 feet.
Yeah. And
I guess part of why I'm asking the question is a leading question around, how do people think about it? And to your answer, well, it depends. Depends, like, where you're up to and how your business is tracking, and like how you want to compartmentalize those things. But there can be really meaningful, useful ways to leverage the value of one of your assets, just happens to be a home, a place you live in, to make your business successful or support your business. But you got to work out whether it's right for you or not.
See, I mean, that's a really, really good point. I'm glad you brought it up. So, for example, let's assume we're having this conversation in 2003. Right? Let's say it's 2003 right now.
When I bought that apartment?
Yeah. I'm your banker, you come to me and say, look, I want to start this business, right?
Yeah.
Should I be using equity for my apartment? It's a primo building, it's A-listed property. And
epic rent.
Worst case scenario, you're going to lose the house, you're going to shut down your business, right? Best case scenario, you're going to buy 2 of those.
Right.
Because you're going to make enough money from the business, right?
Right.
So my question for you would be, if I give you an option A, you can use your house and get funding for your business at 7% per annum, or not use that property, right, and get funding for your business at 20%. What would you pick?
I'd probably use my house. I don't know. I mean, in this case, I needed to buy out a co-founder and I needed money. It was the only place where I still had money.
But with that interest rate, they higher interest rate of 20% justify for you not having to use your security, and the company that's borrowing the money to you, they're just taking pure risk in your business. They're not even touch your apartment, right? Or would you let the bank say, look, we're happy to lend you this money at 5%, but we'll take a security and guarantee from you, equity guarantee on the apartment. So what would you prefer?
Yeah. I mean, what I should have done is this is going to sound trite because we're talking about it, but I should have talked to a broker who said, why are you selling? Just use the equity to pay the guy out and then leave the debt where it is and continue to service the debt where it is. You don't need to sell this thing. You could have just kept it. Anyway, we're down in the rabbit hole. All right. So the thing with home loans is that it's very subjective as to what extent you might use your home loan. If you're coming back and I don't want to go too far into this because I think that self-employed home loans is an entire thing. Like as soon as you're a director of a company, and that company is where the income's coming from, maybe you pay yourself from that company or you're a shareholder over X%, somewhere between 5 and 20 or whatever, then people will consider you self-employed. And now to even get a home loan, they're going to look at your business and they're going to look at that, right? So I think putting that to one side, the question of to what extent you use your business to buy the home or use your home to fund the business is incredibly subjective and personal and depends on your risk tolerances and where either of those things might be up to. But it is still a dialogue.
It is still a dialogue, and that's why it's really important to engage a broker or a good business banker as well.
Right.
Because you're putting your house on the line, right?
Yeah.
You want to have a full analysis of the business that you want to acquire.
Yeah, you want to understand kind of, to your point, like come in and run the numbers. This is what, if it goes well, you land here. If it goes not so well, you land here. If it goes really well, you land here. If it goes really not so well,
exactly.
COVID level event, understand that this is the reality. Do you accept the reality?
Correct.
Future reality. Yeah, I mean, obviously it hasn't happened, but the future potential reality.
Exactly. And that's why I said, like, if the banks decline your loan at times,
yeah,
it could be a blessing in disguise because you would have placed your apartment as an asset to get that debt right. And the banks think it's a risky proposition and that they sort of saying no to you.
Yeah.
It's a good sign for you to walk away from it.
Yeah.
Typically, right?
Yeah.
Because they're doing the assessment for you, right? And if then you can go to a lender and get higher interest rate, which is just an asset lender and say, like, well, we'll help you open that business up 15%.
Yeah.
But they do no cash flow analysis for you. They're like, they give you free money, charge you a high monthly fee.
Yeah.
It's possibly a trap because you're running a new business and your cash flow is going to be pretty, like, your debt interest rate is going to be pretty high as well.
Yeah.
So it's a double whammy for you as a business owner.
Okay. And so we've talked about the baseline of funding and your background, obviously, in treasury and understanding kind of how, I think you called it the ripple effect. Is that what you called it? The ripple effect, where the funding levels down here contribute to the funding levels. That's kind of, it's all connected. Maybe I'm using the wrong term. And then into kind of what types of funding happen at what stages of businesses and the types of funders who you might have, banks, non-banks, private lenders. So it kind of begs the question for me is like, where is this all going? And that might be not specifically relevant to a business owner today, but like, what's some of what you're seeing coming down the line in the next couple of years, or even the short term, around how businesses get funding and how funding helps businesses? Like, what's the future?
Yeah, that's a good point. Over time, what I realized in banking is like, having spent almost a decade here, it's like I get call from people saying, he's got, like, for example, I get clients who got a really good job, doing really good, like, they're mortgage free.
Yeah.
And they'll call
mortgage free.
Mortgage free, yeah. And they'll be like, well, I want to buy this commercial property.
Okay.
And I'm like, okay, fair enough. What's the goal? And it's like, well, it's going to give me some capital gains, make some money, or retirement, like, it's going to be cash flow when I retire. It'll be my sort of retirement fund and so on. So, and I just think to myself, like, he's in such a good position. Why is he taking more debt, right? Mm-hmm. Why does he want to go into this whole world of macro risk, the interest rate risk and so on? Because I think naturally, and this is a very philosophical point, right? Humans, we're very inclined to taking more risk. Right. So, and whether that be buying new home, new business, new commercial property,
new car.
And once you get fixated to a property, you just start believing in it. Or if you want to buy a business, like if I want to open a gym, you call it the red car effect. I look at all the successful gyms in the world and I'm like, well, this is going to do so well. It's my passion. I want to be a gym owner. Right? I love working out and stuff. And you sort of ignore all the negatives about it. You probably will see a lot of businesses that used to be in the area now, like they shut down. There's 4 lease signs all on the door. Yeah. But you just think that you have a different, like a unique proposition that's going to break the market. Right, and stuff like that. So like it's the natural tendency of humans to take risk in general, and that's why the debt's there. The banks are there. The normal banking lenders are there because there's something you believe in and you want to go for it. But at the same time, it's very short-sighted. Like I talk to people on a day-to-day basis about interest rate, and if there's 3 rate cuts right now in this year, they get this whole perception the interest rates are going to be now low, and it's a great time to get into the property market. Right. And it's a great entry point. I'm going to get like the interest rate's pretty cheap. And I always tell them there's 2 components to it. There's cost of money, and there's the cost of asset that you're paying. Right. So the cost of money may have come down, And usually they work in negative correlation. So the
Mm.
cost of money comes down, the interest rate comes down,
Yeah.
the cost of the asset goes up.
Right. Inflates.
And it balances it out.
Right.
So you're buying a property and then the interest rate's up 2.5%, but yeah, you're sitting like raising your hand in the auction and paying 10% more than the property value.
Right.
You're even yourself out. Right.
Yeah.
So what is your strategy? Like, what's your entry point? Like, the market's going to squeeze your money in one way or the other. Right. And what's your long-term strategy as well? Just because the interest rates are lower today and the bank will approve you for a 1.5 million home loan doesn't mean you go and buy one.
Sure.
Right. The bank will raise the interest, and it will eventually raise the interest rates back to 5.5, 6%. How are you going to cope up then?
Yeah.
Right. And I think the cash flow risk is a big component which brokers don't touch on, the bankers don't touch on, and the clients get too fixated on the property they want to acquire or the business they want to acquire.
Or the upside of the equation.
And they're like, it's a property. The property market always goes up, right? If I'm in trouble, I'll sell it. And look what happened. Look what's happening right now. A lot of people last year were trying to sell their property but couldn't.
Right.
The clearance rate was pretty low in Melbourne and Sydney.
And so coming back to like this idea of like what's happening into the future, part of what I'm thinking is if you think back 30 years, 40 years, and you wanted a loan, you had an existing bank manager who you knew, who worked at a physical branch, and you wandered in there and were like, I need another coffee machine if we go back to our example. Fast forward 20 or 30 years, yes, you still have your banking relationship. You probably have 3 or 4 banks that you work with. You might have a fintech who's looking at all the money in one of those banks and helping you understand where to put any excess money. And you have a commercial broker who's looking at banks, non-banks, fintechs. So it's entropy, right? There's just more and more options becoming available. But the fundamentals, market cycles, ebbs and flows of risk and, cost of capital and asset prices, and whether these are inflated or underpriced, those cycles really are those fundamentals aren't changing.
Exactly.
It's just the availability of things to help you do the thing you currently want to do, which you think might be a good idea, is becoming broader and wider. That's becoming more of a challenge.
Exactly.
But you ultimately need to get back to, is this a good financial decision? Should we be doing this? Should we be doing this now? What happens if?
Exactly.
Yeah, okay, cool.
Because people look at lagging indicators, like in economics, right? For example, there's a lot of leading indicators. So what's going to happen with the economy or what's going to happen with the interest rate? I'm not an economist myself, but I'm just saying, for example, if the unemployment rate is pretty high and the inflation is running pretty low, the inflation is pretty high as well. There are high chances the government's going to drop the interest rate.
Right.
High chances, not saying because most likely that's going to happen, right? But then that gives you a pulse of what's going to happen. Or so if you are a prudent investor or you've got prudent bankers or brokers that are advising you, you get into the entry point in the market where there's a high chance of interest rates dropping up and there's a high chance the auction rate, clearance rate's going to go up. I might as well get into the property market right now.
Right.
And they are lagging indicators. Then where the news is the property market's booming, the property market's the properties are going on auction, there's a 90% clearance rate. And that's when a lot of people say, I need to buy a house because it's going up. But it has already gone up.
It's gone up, right.
So you missed the wave. Right. So they don't need to, they need to have good advisors that sort of tell them, look, if you were looking to get into a property market, now is probably a good time.
Yeah.
Right. The interest rates are slightly higher.
Yeah.
But they're probably going to be low in 6 months' time. And then that's when the market's going to move up. If you're looking at an entry point, I can help you.
Right.
I'm not saying you should right now, but if you were looking to, if you want to buy a commercial property or open a business, it's good macro environment to sort of start looking into it.
Yeah.
And people don't have that.
Right.
Because there's no banker that will proactively call you and say, look, buy a property.
Right.
They're mostly reactive. You call them and say, I want to buy a property. They're like, okay, send me these documents.
Yeah. So just I want to get to kind of the key takeaways from all of this in a second. But before we get there, part of kind of the consistent theme through this is this stuff is it's subjective, depends on where you're up to, what you're trying to do, what your goals are, what your risk tolerance is. It's obviously complicated and that there's a lot of different options in the market and they're all viewed differently. So clearly trying to do this stuff by yourself isn't the way to go, right? So that's established. But as someone who runs a business, let's say you run a cafe, is there any part of this where you're like, you know what, it would really behoove you to upskill a little bit and get a bit more educated in these areas, understand macroeconomics a bit, or just watch these segments or follow these 1 or 2 people and listen to their stuff and just try to get a basis of it. Is there any aspect of this where it's like, honestly, your business will thank you if you go and upskill a bit? Is there any of that for a business owner? where it's not their core thing.
Yeah, so I mean, look, the only problem in the market these days is over information.
That's what I mean. Yeah.
Yeah. So if you want to talk to a buyer's agent and you type in buyer's agent in your Google, you probably get a call from 20 different buyer's agents tomorrow.
Sure.
And they'll all give you different information or same information.
Yeah.
But if it's the same information, there's an information overload because everyone else is getting the same information as well. So you're not ahead of the curve at the moment, right? But I think it's good to have a trusted advisor.
Yeah.
A good business banker, for example, can take you places.
Yeah.
A good accountant at times, a good network of real estate agents, and a good broker.
Yeah.
Or could be a broker who's got all this network already that helps you guide through. Okay, you want to buy a property? Here's your pre-approval. But let's not finish that at that. Like, let me connect you to real estate agents who can guide you where it's going to be a good market.
Yeah.
Or I know a buyer's agent who can help you navigate through property market in Melbourne. And if you're looking for returns, it doesn't matter if that's in Perth, Sydney, South Australia.
Yeah.
Right?
England.
Yeah.
Sorry. I promise that's the last one.
Michelin, right? Exactly. But you wouldn't know because you just know that, for example, if I'm going to buy a property and you told me that suburban, like the apartment with Russell Crowe, I've got no idea. Maybe there's good return sitting in there. But I'm not able to sort of explore those because I don't know the area or Sydney market.
Sure.
So it's that network will take you places, and I think a good broker, financial advisor will. But look, the challenge with having a good business banker is they move around a lot.
Right.
A good business banker gets hunted and moves from A bank to B bank, and so you climbing him up, it's like he's gone, he's moved. As a new business banker, that's going to picture. So you got to repeat yourself to the new business banker and tell him, look, I'm a manufacturing company. This is what I do. This is my turnover.
Yeah, all the things.
Blah, blah, blah. And the next thing you know, he got promoted.
Yeah.
And there's a new business banker in place.
Yeah.
So you always sort of, explaining yourself to different bankers, different business bankers, and one might come along and say, look, I don't think this is going to work for you. Because he doesn't even understand your business. He's new in the role or he's inexperienced.
Yeah.
And that's why having a good broker sort of brings the value in.
Yeah.
Because he will take the pains to understand your business and explain that to the different banks and seek funding on your behalf.
Yeah, I mean, look, for me, it feels like, I'm not here to throw banks under the bus. Obviously, there's a great amount of products, but they're good at manufacturing products to solve problems at a certain stage in a business. But if you talk right up front about a business, it's going through stages, and those stages start with probably not a lot of banking products other than maybe day-to-day transactional and maybe some form of overdraft. Yeah. But the other types of products that you need at that stage that are debt-related are coming from other places or even other banks.
Exactly.
Right? And so if you've got a banking relationship, you need a banking relationship. You're going to have a bank because you're going to put money somewhere, right? Yeah. So clearly you're going to have some banking relationship. But the advantage of having a commercial broker is continuity across this 20, 30-year arc of a journey that you're going on with your own business, and each of the products, and they're not limited to a particular set. So I totally get that. And then in terms of just my original question around trying to get a bit more informed, I'm kind of playing it back to you, but it sounds like if you want to learn more about this stuff, it's out there, but there's a lot of noise out there, and your better bet was kind of to find good people around you who have expertise in these key areas: commercial brokerage, financial strategy, great accountant. If you're going into the commercial property thing because for business reasons or because you just want to speculate or whatever, then having good agents who are good in that space, and they all kind of know each other. You find a good broker, you tend to find the good other ones because they all want to work with good players. All right, cool. So out of all that, I want to understand kind of our key headline takeaways from you out of everything that we've spoken about today. Like, what are the 4 or 5 big ones that just punch it between the eyes and wrap us up nicely?
I think the first and foremost is do your analysis right. If you're acquiring a business, acquiring a property, and if you don't have the time or the expertise, speak to a banker, speak to a broker who does the analysis for you. Like I said, all these complicated terms of hurdle rate, what's the return going to be,
WACC,
time that was WACC, yeah, exactly. So all these sort of things, you've got to work that out and make sure. And I call it a feasibility test.
Right.
So is this business feasible for you?
This business or business decision?
Business decision is feasible for you. Is this going to make you money in the long run?
Yep.
Is the money it's going to make worth the risk as well? So do you do analysis, like do proper analysis? If the banks turn you down, think about it again because they've got a strong reason because they want to borrow money to you as well. And if they're not able to, there's some red flag somewhere.
Sure.
So that's A.
Point number 1, yeah.
Point one. Yeah. Point number 2, your cash flows, right? You're acquiring assets, that's great. Link your debt to your asset, the duration of your asset to the useful life of the asset to the duration of the loan.
Yeah.
They link it up pretty well.
Yep.
And in terms of interest rate, don't be fixated on the interest rate. The structure plays an equally important role as well.
All right. Okay. Well, give me an example of that in terms of like who will do the deal, or like what fees come with it, or how quickly. Like, what's the structure aspects that you're referring to there?
Right. So, like, if you're getting into a business transaction that involves a bit of risk, be prepared to pay a little more interest altogether. So, for example, if you're buying commercial property in Mickleham, right, which seems to be enough coming in.
That was you. That was all you. Well, I'm glad you're on board with the
So there's you want to do some land banking in Mickleham because you have a great idea about the area that it's going to pick up heaps, right? And you're going to sit on a piece of land, and the banks won't come to the party, but you see great potential or upside on that holding that land. And if your interest rate is value 2 or 3 basis points, 2 or 300 basis points higher than the market, be prepared to do so, because you're getting into a riskier transaction. There's a correlation between risk and the interest rate. So be prepared for that. Manage your cash flow really well. My third key takeaway is do not be fixated on the short-term interest rate. Do not base your decisions to acquire business or property just because of what the interest rates are right now. Look at the long-term perspective, right? If you don't know that, look for advice from your broker or banker, or follow some macroeconomic trend and see where the interest rate's going to be in 5-10 years. And if they are meant to be higher, the yield curve goes like that, and it's showing you that in 7 years' time, the interest rate's probably going to be 7.5%. Prepare yourself well for that.
Like run the numbers, assuming they were 7.5. Would you still make the decision today that you're going to make it 2.5 or whatever that example was? Mate. Did he end up all right, by the way?
No, he did.
I hope he pulled through.
I think he sold one of his houses. I think he was pretty good property. I had about 17 apartments in Sydney and Melbourne. So last time I spoke to him, he was offloading a few apartments just to try and keep up with the loan payments and so on. In the hope the property price is going to move positively for him, but that, and that's the position you don't want to be in. You got great assets, but you got cash flow issues.
You never I've experienced this. You never want to be a forced seller ever.
Exactly.
If you're being a forced seller, it means you're selling at a time where everyone's having to sell most often. Like the 3 times I've been a forced seller, all margin calls, of course. I've sworn never to do any more margin calls. I mean, I've done okay out of margin generally, but all 3 examples was like it was a margin call. Like, right, that product's clearly not for me. I don't know how to manage the risk. And then final kind of shout out to anyone who's a business owner, like if they've listened to all this and they are thinking about their business and trying to think next, like what's their next best step?
Right. First of all, like business owners, right, they take the risk. Like, I mean, to leave the comfort of a job and running a business is the risk they've taken already. So they by inclination risk takers anyways, right? That's what I like to think, right? And the goal is to keep them afloat in terms of cash flow, right? And either a business is doing really well, or just breaking even, or struggling. In all these 3 cases, that's going to be a solution for them, right? They're struggling temporarily, I hope. Right. That's probably going to be a solution. There's some working capital injection that they need and sort of keep them afloat for the hard time. If there's seasonality issues, or the sort of rebranding themselves or re-strategizing the whole business.
Buying a bunch of foundation pile, whatever.
Exactly. So that's probably going to help them, right? And if they're doing really well, that's going to help them grow. Right. If they're doing really well, they might want to open another branch, or they want to acquire some other assets and stuff, right? And in either cases, it's good to have an advisor who you can just call and brainstorm with and say, Nick, look, I'm looking to buy this property. I'm like, no, don't do that. It's negative cash flow. There's too much turbulence in that area, and the interest rate market doesn't look that great.
Or let me ring an agent who I know in that area and let's get some intel before you go ahead with this crazy idea that you've got.
Exactly.
All right. So in closing, it all starts with a conversation. Develop a long-term relationship with a commercial broker. Here's an example. and have that person and that team of people around you make better decisions, and don't pay yourself into a corner.
Absolutely.
Amazing.
Pretty much.
Nick, thanks so much for joining us today. That was a lot. I learned a lot. Hopefully everyone gets a lot out of it. And for anyone who's a business owner at any stage in your journey, give Nikhil a call. He's been in it long enough, knows about it heaps, and can help you out, I'm sure.
We'd love to help. Thank you.